My name is Nick Fluellen. For those who I don't know that are joining this call, I'm a senior managing director at Marcus and Millichap in the Dallas office. My partner Bart Hoover and I run a large apartment team between what we're doing in the DFW area and our secondary markets team. We cover most of this region. Before we kind of get into a lot of the content for today, first and foremost, I just want to extend my warmest well wishes for everyone. I hope everyone on this call is staying healthy, safe, and sane right now. Quite honestly, it's an unprecedented time. I've certainly heard from a number of people over the last couple of weeks that while it's definitely a stressful time, there's been a lot of good that's come out of it with good family time and time to just kind of slow down and catch our breath a little. And so I sincerely hope everyone is doing well and finding some of the good things that are coming out of this to enjoy. So on behalf of Marcus and Millichap and Old Capital, we're thrilled to have everybody on this call today. We had more than 1,400 people register for this call, so it's clear that in this time of uncertainty that there's a lot of desire to have information, and it's moving quickly. So we were able to put together a great group of professionals here, and Paul will tell you more about those in a second. But wanted to also remind everyone there is a little at the bottom of your screen, there is a little chat feature, a little chat bubble. There's two elements that you can use. There's a chat that you can talk with everyone on this call, the participants, and then at the bottom there's a little section that says Q&A. We've got a number of questions right now. I don't know that we'll be able to get to all of them, but we will get to some of them. So if you have a question throughout the presentation, we're going to leave some time at the end to try to address those. And so please feel free to leave that there, and we'll try to get to the ones that we can. Before I turn it over to Mr. Peebles, wanted to give you all just kind of a quick update on the brokerage side of the business, at least our business. I've been asked a lot about deal flow and what's going on in our world right now. You know, in January and February and early March, we closed 17 deals. It was the best start to a year that we've ever had in my 16-year career. And so all of a sudden, just like that, as many saw and experienced, the faucet turned off, and we had a number of deals that died. We actually still have 5 deals right now that are, believe it or not, that are in escrow and that we're trying to move towards the finish line. And I'm confident that we'll make it there with some of them. So it's not that no deals are happening, but it's certainly a little more challenging right now. And in the last 30 days, we've signed up a couple of deals, but I would say universally, pretty much people are waiting and seeing at this point for doing anything with assets and trying to market new deals. So how long is that going to be? When's going to be the right time to turn around and launch these deals? I don't know the exact answer to that. I will tell you that the things that I'm monitoring most closely right now, like many, is when are we going to turn the economy back on again? And I think we're going to get some clarity on that, both on a national level and certainly on the state level here in Texas here very soon. I think a second indicator that I'm following and will be following is how quickly people will be rehired that are unemployed right now or that have been furloughed. And I think that's going to be a pretty telling stat. And then the third thing that it's too early to have an answer for, but I think once we do get an answer, we'll go a long way to addressing how quickly deal flow starts happening again. Is this going to be a V-shaped recovery or a U-shaped recovery? And I think to the extent that it's more V-shaped than U-shaped, then we'll get this thing going sooner rather than later. But I think right now we just don't know. And there's a lot of habits that have been formed in this time, and we don't know how long it's going to take to get back to normal. So, with that, we're staying positive. We're working as much as we can, just trying to be a resource and be informative right now. That's really all we can do. I can't prove that positive thinking works, but I can certainly prove that negative thinking works negatively 100% of the time. So we're trying to get as much as we can out of this and be as big a resource as we can during this time. So with that, let me turn it over to my friend, Mr. Paul Peebles.
Thanks, Nick. I appreciate you kicking us off here. And so I think Nick and his group are going to be a little bit more optimistic in their talk, and we're going to be a little bit more cautious on our side, just the FYI on that. That's the difference between being a banker like us and being somebody that's in the throes of things like Nick. And, we kind of rely upon Nick and his team to kind of give us some guidance about what's going on out there. So I appreciate everybody being on the call today. Could you imagine 45 days ago that we would have over 1,000 folks on a conference call in the middle of the day, especially a work day like this? So hopefully you've taken this opportunity to come together with your family and your loved ones and on one long extended spring break vacation. So I'm excited that you're here. So we appreciate your time and spending some time with us. So the purpose of this call today is to give you the best information possible from the thought leaders in apartment real estate investing. We wanted to leverage our database with our top colleagues in apartment investing to give you the better understanding about what is happening. So for the next few months, we're going to have consistent conference calls every 2 weeks, just like this. So we look forward to seeing you back in about 2 weeks, 2 weeks from say today. And we're going to set up a similar conference call with a different group of thought leaders that I think you will very much enjoy. So we're putting that together right now. So we'll give you the invitation. I extend you the invitation to come back and see us 2 weeks from today. So we want to bring the top thought leaders in commercial real estate with their knowledge to help you overcome the challenges with this extended but temporarily spring break vacation that we're all on. So this is fluid information that we're talking about. So what we say today could be totally different in the next week or two. So today we have several thought leaders in apartment investing. So the first one is T Chang, and John serves as Senior Vice President and National Director of Research for Marcus & Millichap. John is responsible for the production of the firm's vast array of commercial real estate publications, tools, and services. Last year, his team authored over 900 research reports and over 10 different property types. If you've never met John, you probably read one of his reports. So he's going to explain the kind of the big picture about what's going on. And so I'm going to welcome John to this call. The second one is going to be John Sebree. And John Sebree is Senior Vice President and National Director of Marcus & Millichap under their National Housing Group. He's based in the Midwest, working from the firm's Chicago and Indianapolis offices. His extensive background as a major multifamily specialist spans more than 20 years. Before he got into this national director role, he was one of the top producers for Marcus & Millichap. He babysits thousands of Marcus & Millichap agents throughout the country. John is going to give us his insight into the National Multifamily Housing Group and what they're doing to assist you. So thanks, John, for being with us. Third, Michael Becker, the professor, is going to be joining him. But Mr. Michael Becker is going to be joining us. He's principal of SPI Advisory and heads the Dallas's SPI office, where he oversees all aspects of property operations, including asset management, property management oversight, accounting, taxation. He oversees 6,000 units between Dallas and Austin. So we're going to ask him questions concerning apartment operations and communicating with your partners. And what he's doing, I think, should be a model what you should be doing, what you should be receiving if you're a limited partner. And then finally, we're going to have the professor himself. That I should call him Dr. James Zhang because he's as smart as any professor I know. So James Zhang is in the house. James is with Old Capital. He's originated almost $1 billion in apartment loans his last couple of years. Before that, as you know, he was with GE Capital as an underwriter, spent almost 10 years with them. And so he has a great perspective of things that went on in the last recession and what it is going to look like today. So again, I appreciate everybody being on the call. Just like Nick had said if you do have a question that comes up, make sure you go into the Q&A, type it in there, and we'll try to get to it. And I promise you, we're going to try to be over this call within the 60 minutes. So we appreciate your time. I'm going to turn it back over to Nick.
All right. Well, John, I will bring up your slideshow here, and you can walk us through some of the things that you're seeing on a national level right now. And for a lot of the people on this call, you're constantly getting research from our team. Almost all of that is generated from John and his team, and so John is truly one of the secret weapons that we have, and I'm excited to just kind of let him share some of his thoughts with you guys and talk about specifically how this downturn that we're dealing with right now compares to what we've dealt with previously. So, John, take it away.
Great. Thanks, Nick. Can you hear me okay?
I can hear you.
All right, fantastic. So I'm going to talk about three things. The first is how the global health crisis compares to the global financial crisis. Then I'm going to talk about some of the key features of the stimulus package and the implications for the apartment sector. So what you see on the screen right now is just a quick snapshot comparing where we are today compared to where we were in the last cycle. The first one is jobs. We had 10 years of job creation in this cycle, which really dwarfs what we had going into the 07 financial crisis, almost triple the number of jobs created this cycle. When you look at household income, it's 25% higher than it was going into the last cycle. And when you look at household debt, it is dramatically lower. So people and households are in a much stronger financial situation this time around than they were going into the financial crisis. When you look at the banks and the corporations, the bank reserves are dramatically higher. The banks are very well funded coming into this cycle. Corporate profits are elevated, very strong, near all-time highs, and the cash on hand for corporations is at an all-time high, and that will support businesses to carry through the challenges we face. So this situation is much different from the global financial crisis. I'm going to kind of rewind a little bit and talk a little bit about that. Really, the global financial crisis was driven by the financial system. There was over leveraging, there was massive speculation, and there were compounded derivatives. Essentially, it became very complicated, and there was a lot of money being bet on the markets. When we went into the crisis, there was really no game plan. There was no Federal Reserve playbook to work with. The stimuli was really focused on shoring up the banks, and it was a very reactionary, slow process that we were going through at the time. When the economic damage was done, the financial system repair took a long time. It took almost several years to get to a resolution that would drive economic growth. Now, the current situation is a health-driven crisis. The banks have money, households were in good position. Overall, economically speaking, people were in pretty good shape. The next component is that the health crisis is shutting down the economy. And this is not a situation where the economy is breaking, but really where we're proactively shutting down whole segments of the economy. And this has never happened before. And there is a potential that this rolls into the economy and causes that economic damage that's comparable to what we had in the global financial crisis, or even worse. We've seen the spike in job losses. We've seen numerous companies moving to the sidelines or moving on to life support. For example, the airline industry, which is just got a pretty significant bailout. And if the difference here is that even though it could be impacting the financial crisis, the next piece is the massive decisive action by the government. So that has entailed both Fed action, which they have poured $2.2 trillion into the economy in a very swift series of moves to support lending, to support the financial climate, and ensure we don't have a financial market lockup. But it has also included the stimulus package, which is about $2.2 trillion. Now, that stimulus package is broken up into 4 pieces. The foundation of it is really built on the health concerns. How do we get rid of this pandemic? How do we solve the health problems? And that's about $500 billion that's focused on that segment. That is really absolutely crucial. Another $500 billion, predominantly in loans, is allocated to large corporations, and that is a very significant portion. That is where the money for the airlines is coming from, and that's going to be a key ingredient supporting the large corporations. The portion on the left, which is a little smaller, about $377 billion, is dominated by the small business forgivable loans, the PPP, which is $349 billion. I did see a question in there about whether or not apartment investors can access that. And to my understanding, the last I saw on it was a couple days ago, and there had not been any movement there. And quite honestly, it may be too late for this round. The PPP, basically what it did is it allows small businesses with fewer than 500 employees to go get a loan through the Small Business Administration and through their local banks to help cover payroll for 2 months. And if you used it predominantly for payroll, 75% for payroll, then that loan was forgiven. And so basically the government is paying for your staff for about 2 months. There's a lot of nuances to it, but that's just a rough sketch. As of Tuesday, of that $349 billion, $257 billion had already been deployed in 1.1 million loans. It is expected that by the end of this week, that initial set of capital, that $349 billion, will be deployed. The Treasury Department has requested another $250 billion to be added to that pool. Congress has to approve it. That hasn't happened yet, so that may be the next piece that we see coming out. And there at the top, we have the benefits for individuals, which includes the cash payments. That's $1,200 per person plus $500 per child. It phases out over incomes of over $75,000. So a family of 4 would get $3,400 if they make less than $150,000 per year. That's also offset the unemployment claims with an extra $600 per week from the federal government on top of state benefits, and that is extended out through the end of July. There's a hard stop at July 31st. Basically what that does is it increases people's benefits by about $2,400 a month, taking the benefits up into somewhere between $3,300 to $5,600 per month, depending on the state they live in. So these functions are really focused on creating a bridge for the economy to get over this chasm of the pandemic and carry it forward for another 3 to 4 months so that it is primed and ready to go when we get through the worst of the pandemic. When it comes to
John, let me just stop you real fast. I've had a couple of comments that that is a great slide, and yes, that will be available after this this webcast or webinar. We will send a copy of the webinar out, but yes, that will be available. So for those wondering, we will make sure you get a copy of that.
Yeah, I also see a note here about the gaps in the stimulus, and absolutely, but you have to remember that this was put out in record time. During the last cycle, it took quarters. It took several quarters before we had anything out there. They deployed this package in weeks. And I know that there will probably be more coming out depending on how long this lasts. I put together this brief little matrix. I'm not going to go into all the details, but essentially we face very different situations, and I kind of penciled out 4 here. If we are in shelter in place and a lockdown for a very short period of time, less than 3 months, and we have a fast recovery coming out of it, that is a V-shaped recovery. And the apartment sector faces, basically, it's like hitting a pause button for a couple months, and we come out of it, and you know, there's a little damage, but not a lot, and we're able to resolve those things pretty quickly. In the bottom left, it's a short downturn here, followed by a slow recovery, kind of the Nike swoosh concept. In that case, we see household formations slowing down. We see some vacancy rise. We see some concession use, but not a severe hit to the sector. In the top right, we have kind of a long shelter and or a second wave hits. But that's followed by a fast recovery. There will be more extensive damage to the economy and to the apartment sector if that happens. People only have a certain amount of runway to survive and carry forward. But the good news is we come out of it and we can repair the damage. And then, of course, there's the worst case scenario where this extends, it's long, it has a second wave, it carries over into 2021, and then we face a slow recovery coming out of it. That is the one that we're most concerned about. That is going to be dependent upon the health, solving the health issues, and Congress will likely deploy much more stimulus if it looks like we're going into that situation to keep the economy and all of our businesses afloat. So with that, I'll wrap up and I'll pass it back to Nick Fluellen.
All right, John, thank you. I appreciate that. It's great information. Obviously, this stuff is changing daily, so we appreciate you even having slides for us. So for those who are on the call right now, keep that in mind, and we'll try to bring you the most current, up-to-date info, but it is changing rapidly. So I'm going to turn it over to Mr. John Sebree. And so John brings an interesting perspective to the table because unlike many on this call who are focused primarily in Texas and deal flow in Texas and all that, John is frequently on an airplane, or at least he was before all of this, and working with all of our agents around the country. And so John would love to just kind of get your thoughts on the apartment market in general, and also on NMHC, which Marcus and Millichap is extremely involved in. I think there's a number of folks on this call who maybe don't know a ton about what NMHC does, and so perhaps you could shed some light on that.
Absolutely. Thank you very much, Nick. Appreciate everybody being here. Paul, appreciate you having me on this as well. As Nick said, my name is John Sebree. I'm National Director of Multifamily. So a big part of my job for the last several years has been kind of bouncing around the country and meeting with large groups of people. So it'll be interesting to see what I'm doing next month. Because it seems like everything has changed a little bit. But first, let me say, I hope everybody hope you and your families are doing well, safe and healthy. We're certainly living in interesting times. From a national perspective, I want to make a few points. First is that we're roughly 4.5 weeks into what is an unprecedented health crisis shutdown in our economy. So there's really no historical reports that we can look at, nothing we can review for guidance that will tell us how this thing plays out. And there's no way to really gauge what the social implications of all of this are going to be as we come through it and as we come out the other side of it. So there's a lot of unknowns, and as much as I am used to standing up on a stage and presenting to people and telling them exactly what's going to happen, I have no idea. And I think we're all kind of trying to figure this out. But I will say one of the first metrics that I'll mention that we're watching very closely is obviously collections, is rents. So everybody spent about 2 weeks talking about what April rent's going to look like, and then on the first day of the month, how much did you get in? On the second day of the month, how much did you get in? Everybody was really trying to gauge that and trying to understand how it came out. I'll give you my personal unsophisticated opinion as somebody who has spent the last 4 weeks several hours each day on the phone with large owners in every corner of the country. But I think most owners came in with most owners in kind of that B and C product had about a 5 to 7 or 5 to 8% collection loss for April, and a lot of areas it was a little bit better. It was the lowest in really the middle part of the country in the Midwest. I think a lot of that was more like 3 to 5%. It was a little bit higher in some of the tourist areas like Miami and Orlando and Las Vegas. California is a little bit different. California was 12 to 15%, and the reason is that they've got a big campaign out there telling everybody they don't have to pay rent and they're going to go on a rent strike. I was talking to several owners in LA last Friday, and most of them said they were 12 to 15% economic loss or unpaid rent for April. And I said, how many of those people still have a job and can still afford to pay rent? They just know they're going to be able to scam the system. And they said about half. So that's just, I wouldn't recommend trying to do that in Texas. It's a little bit different climate, but that's going to skew the numbers just a little bit. May rent collections are likely to be a little bit worse as tenant savings have been depleted a little bit. The unknown is when tenants are going to start receiving some of the government money that's coming out, right? So if they filed for unemployment in the third week of March, then they should be receiving their first check this week or next. The additional amount of up to $600 per week should begin arriving by late April, maybe beginning May. It should be late April is what they're saying. The government also continues to state that by the end of the month, people are going to be receiving their $1,200 per person check and $500 per child. And if the tenant's employer filed for the SBA PPP, this money should be getting paid out by the end of April or the beginning of May, which, and according to those guidelines, 75% of that money needs to go to pay for wages and pay for the employees. So in summary, many people have lost their jobs, but the U.S. government, the whole CARES Act is the U.S. government is stepping in to give the money to the tenants or give the money to the people so that they can pay their bills. Right? And they're doing this in several different ways, which I just laid out. Now, what we don't know is if tenants are going to actually use that money for rent, right? That's part of the unknown. But if we take a step back and we look at the multifamily industry from kind of a national or a macro perspective and where we were just a few months ago, in February, Class C vacancy throughout the entire country was only at about 3.8%. So if the percentage of people currently out of work, a percentage of those people will ultimately lose their jobs. And a lot of them will start moving in with family members, and we could see a flattening or a decrease in household growth, which will lessen demand a little bit. In addition, you'll see people doubling up, right? So 3 people each had a 1-bedroom, and they all decided to become roommates to save a little bit of money. At that point, you've lost 2 households, so it's just part of the metrics. But the net result is likely to be, and again, this is just opinion, but likely to be economic vacancy, an increase in economic vacancy. But even if this increases by 4 or 5%, we're still nationally at an 8 or 9% total vacancy rate, which most owners are going to be, they're going to see that and they're going to feel like they can kind of keep their head above water at that level. The current issue is that economic and vacancy is increasing, but physical vacancy is going to stay the same for the next few months, right? I mean, it will be difficult or impossible, no matter where you are, to really evict tenants, in my opinion, over the next couple of months. That's not a judge that you want to go into and say, I don't care that they got sick and had the virus, I want them out. I mean, that's going to be very difficult. So it's possible that we could see owners over the next few months that are sitting there with 98% physical occupancy and only 90% economic occupancy, right? And that's going to be a difficult transition that we're going to have to work through, because then you're going to have to work through the process of people moving out, and then you can go in and re-rent them. Our benefit is that we were dealing with a housing shortage prior to the pandemic, and even if we increased vacancy and had flat or slight decline in rents, it will likely last, 2 quarters, 3 quarters, 4 quarters. I don't know. It depends what day you talk to me, how long I think this thing's going to go. But then we're going to start to improve. So I'm a little bit concerned about 2020. I am concerned about 2020. I'm a little bit concerned about kind of the first half of 2021. But I feel like unlike retail or hospitality or even office, I think our fundamentals in multifamily are so strong, and our supply-demand balance is even after it takes a hit, we're going to be in such good shape. I think we're going to come out of this okay. On kind of the next topic, on almost every call that I'm on and I'm talking with owners, they're all asking me, what are the other owners saying? What are they doing? What are they doing with their time? How are they, how are they spending their time? We're doing a lot of conference calls in different cities with just different owners and letting them talk and share thoughts and stories. But I thought I would share with you the most important things that I hear what owners are really spending their time on right now. Number one, it's communicating with their employees, making sure they're talking to their employees, letting them know what their game plan is, if they're planning on keeping them, if they're going to need to lay them off, whatever it is. Just be open in the communication of that, and it's important for them to know if you feel like they're still going to have a job on this. It's important for them to know that. Unlike a restaurant that just shuts up and everybody, shuts down and everybody goes home. You're still running an apartment building. You still have people living there. You still have maintenance. So you still have leasing. You still have things that you have to do. The second part of it is communicating with the tenants. I've had a couple of people that have said, oh, you know what, I'm just not even talking to the tenants. We'll see how much the rent shows up. That, in my opinion, those people are not faring anywhere near as well as the tenants that are being, or as the landlords that are being open and reaching out to them. Next, communicating with your lender, making sure that they know. I mean, if you think you're going to need to be talking about forbearance in 2 or 3 months, I would start talking about it now. Just start seeing what they're going to be able to do. If you've got enough cash to carry it 6 months, make sure your lender knows that too. I mean, making sure you have open dialogue. Talking with your investors, making sure investors know what what is happening. I know a lot of people are holding off on paying out dividends. We may see some people that have to do some cash calls. Think to a couple of months down the path. This thing is not going to end tomorrow, right? We're not going to wake up on Monday morning and the sun's going to be shining and we'll all be like, wow, was it a bad dream? No, this thing's going to stick around for a while. So think about that. And then finally, communicate with your Marcus Millichap agent. You've got to. And I say that with a little bit tongue-in-cheek, but John Chang just spoke. Our research department has been putting out a tremendous amount of information, very valuable information. So you certainly want to be on that distribution list. Nick had mentioned NMHC, so let me touch on that real quickly. If you own apartment properties, NMHC is the National Multifamily Housing Council. It is the single largest lobbying effort in Washington, D.C. focused on the multifamily industry. During the past few weeks, I am literally on the phone with them every other day, just talking with them about what's happening in the industry, what they're arguing for on Capitol Hill. A few of the things they've been involved with include the extension of the timeframes for the 1031 exchange, and they're working currently to expand the PPP to include multifamily firms. They're working to align the mortgage forbearance and the eviction protections a little bit because those didn't play out quite as well as I think they thought. So if you're an owner of multifamily, I can't stress it enough. I encourage you to look into that. I encourage you to become a member. It's a not-for-profit organization, but you want to make sure that you've got a seat at the table. If not, if you don't have an objective that you're trying to accomplish, you need a seat at the table to make sure that you're not collateral damage to somebody else's objective. So the last thing I want to touch on is just motivations of buyers and sellers. We have definitely seen an increase in the delta between buyer and seller expectations just in the last few weeks. We're in uncharted territory. As of today, it's impossible to determine the length or the severity of this economic shutdown. So talking with our agents throughout the country, I mean, we continue to work with buyers and sellers. We're continuing to get deals to the closing table. We're continuing to get deals funded, which is good. But certainly transaction volume has fallen off, and a lot, in my personal opinion, over the next 3 or 4 months, it's gonna remain very low. Some owners will continue to put deals on the market for various reasons. Some of them are going to need to free up cash. Some are going to be concerned about the economic, just the economy, and feel like this is going to last for a lot longer period of time. And then you've always got estate issues and partnership breakups. So there will still be velocity. There'll be deals on the market, though. And I think it goes without saying. I think we'll probably see, because of the uncertainty, we'll see some values diminish. But I am not of the opinion that we are going to see a huge decrease in values. So determine what huge is for yourself. But I don't think it's going to be like in 08 and 09. I think values are going to come down a little bit. I think that there are going to be less buyers at the table on deals that are selling, but there's still an enormous amount of capital in the marketplace. So I got a call from somebody last week, and they said, "Oh, you know what? We've been sitting on cash, and we're looking for 9 caps." And I laughed, and I said, "Yeah, everybody else has too." It's just not going to. I don't think we're going to see the 9 cap, especially with rates as low as they are. So if you are going to be looking to buy, be careful. Think about that. You might have to get a little bit creative. If you're looking to sell, are you going to get as much as you would have a month ago? No, but I don't think you're going to have to take an enormous haircut. I think there's still going to be velocity. So in closing, we're in uncertain times, and for the next several months, the path of our economy is unclear, and for the next year, our path to through this and through the recovery is also unclear. Advice from talking to owners to other owners, I'd focus on collections. I'd focus on your employees. I'd focus on communicating with your tenants. Remember, fundamentals were very, very strong 60 days ago, and though we're currently in uncharted waters, these fundamentals are going to be our foundation. They're going to remain in place, and I think that more than anything else, I think that's really going to help us as we can continue through this. So, with that, Nick, I'll turn it back over to you.
Perfect. Thank you, John. One of the, besides, the data that both Johns have provided us with here, I think one of the things for a lot of the folks on this call is I've got a partnership. I'm trying to, navigate my way through this, and obviously I've got a lot of partners who are uneasy, and so we wanted to have Michael Becker join us today. Mike has a number of deals and is taken. I'm actually a partner in a number of his deals, and so we've really enjoyed just how he's communicated through this, and just appreciate a lot of the things he's doing. And so asked Mike to come on and maybe share some of the things that he's seeing, and some of the things he's doing to make sure that his deals are doing as best they can at this point in time. So Mike, thank you very much for joining us.
Thanks for having me on, Nick.
Absolutely. So let's start with just kind of the basic collection info for April. How have collections gone across? How big is your portfolio, and how have collections gone across your portfolio thus far?
Yeah, so we sit today with about 6,000 units scattered across Dallas-Fort Worth and Austin, with the majority of that in Dallas-Fort Worth. And we kind of span the asset quality all the way from workforce housing to brand new. Over the last several years, we've been kind of trading up and taking advantage. What I thought was a little disruption in the marketplace when all the cap rates were relatively on top of each other. So we're kind of selling the workforce housing, C class and B class, and kind of buying A minus A. So we kind of skew a little bit newer, a little bit nicer today than we would have 12, 18 months ago. But overall, we're about 94% collected as of close of business yesterday. So about 6% of scheduled rents delinquent. On any given month, we normally average somewhere south of 1% delinquent. We're pacing along. So I feel like at the end of the month we'll be about 96, hopefully closer to 97% collected. 3 to 4% delinquency. I'm definitely seeing that kind of be a little disparate on the quality of the asset relative to the amount of delinquency we see. Kind of that A minus, we're in the 95, 96% kind of average collected right now, where the B is kind of 6 or 7%, and the very little bit of C class stuff we have is probably closer to 10% delinquent or 90% collected. And Dallas-Fort Worth and Austin are pretty similar to each other. I don't have as much portfolio down in the Austin market, so I don't know if I'm the best judge of the two markets. But overall, in our limited sample sizes, they're both pretty much on top of each other from a collection standpoint.
Well, and you also have some deals, a couple deals in secondary markets too, or East Texas. I know. How has that fared relative to?
We own 3 deals in Tyler as well. Again, relatively small sample size in one market, but that is also probably those are considered, kind of C plus B minus type assets. Those are right in that 93-94% collected range right now. So, again, those things typically close out sub 1% delinquency. So I think all in all, if you would have told me a few months ago, or a few weeks ago, I'd have my over under market delinquency at 4%. And I think I'm going to be under that. I'd be pretty happy right about now.
Yeah, I totally agree. So with regards to asset management, obviously I know, it's something that you spend a lot of time on every month, even when we're not in the middle of a crisis. But what are you doing differently right now relative to what you were doing, say, 90 days ago?
The first thing we did was kind of get in the hunker down mode. We stopped all distribution. So we were a firm that paid monthly. A lot of other people on this call noticed some names. Most of my competitors probably pay quarterly, but we pay monthly, so we turned that off. March, we actually had the March one scheduled prior to this really kind of hitting the fan. So March got paid with April forward, trying to conserve some cash. Another way is we turned off all upgrades. So any sort of vacancies we have, we're just doing basic normal turns, no upgrades, just trying to conserve cash. Any sort of major capital projects on the exterior, if we hadn't already had them kind of underway, we're pulling back on all those as well. Just kind of hunker down, wait and see. On renewals, on new leases, we're kind of taking the guidance of NMHC, which is we're being relatively flat on renewals and new leases. So basically, if you're in a unit, we're trying to keep you in the unit. So if you have $1,000 rent, your renewal likely is going to be $1,000 or maybe even a decrease to make sure we keep you in place. Trying to manage occupancy so don't rental rate growth. So we're giving real soft pedaling, but on new leases, we're not giving away the farm either. We're not seeing, we're seeing demand dry up, Nick. So we don't think if we lower rents $50, we're going to create some sort of demand that wouldn't be there by having $950 rents versus $1,000 rents. No, right now what we're seeing is, as far as like traffic goes, we're seeing leasing's probably down about 10% over average, which is much better than anticipated, but our leasing traffic's probably down 50 or 60%. So those that are out there actively looking are leasing. They're motivated because no one's going to move by choice. There's a reason why these folks are out there trying to move right now. So the traffic we do get, it's highly motivated, highly qualified, and doesn't seem to necessarily be price sensitive. So I would caution people to start trying to slash your rents to try to generate more traffic. I just don't think you're going to get any more traffic even if you lower the rents. The demand wants a lease. So as long as you're have a fair market pricing, we think that the conversion rate should be relatively high.
Well, and I suppose if you're out actually touring a property right now, you're probably not in the market to go tour 10 deals right now. If you walk into a unit, you see it and you like it, you're probably signing that lease. So I'm guessing the closing ratios are probably higher, than typical, even though the traffic is down. So that's
right. Yeah, a lot of it's virtual, as you would assume. So we're beefing up kind of the virtual tours through our websites, the videos. Link to YouTube videos. We have like a kind of touchless tour. Do you want to go physically see a unit? We'll put like a realtor style lockbox on it, give the prospective resident a one-time code. They go toward the unit. When they leave, we come change the code, disinfect the unit, and it's ready for the next prospective resident. So trying to do as much as we can because all the offices, all the amenities are shut down until we kind of get the stay and shelter in place kind of orders lifted, hopefully here in the next couple weeks in Texas.
So let's talk about, as a general partner with a number of LPs across, all your deals, how are you communicating with your LPs? How are you communicating with all the other folks that are involved in these deals, from management companies, on-site staff, lenders, et cetera? Tell us a little bit about kind of what your mindset is right now.
Yeah, so we use third-party management companies to manage our deals. We communicate on a regular basis, so we're big enough. I have an asset manager who is the primary point of contact for the management company, so he's having conversations on a daily basis with the various peoples, which he typically would have in a normal market. And then we're having a twice-a-week call on Tuesdays and on Thursdays, where we're kind of having the head of the management company and the two sub-director of operations, and we're going through kind of major items. So we're doing that. So that's certainly something we're kind of over communicating a lot with the management company, but on schedule, regular intervals. And right now there's seemingly less to talk about than you would think because everything's kind of on autopilot. It was all about ramping up to collections, and now it's about processing collections. The other thing I think that I'm trying to be extremely proactive with is, we have last year I did somewhere around like 1,100 K1s. I have somewhere between 600 to 700 unique investors that have actually invested capital with us. So I'm trying to do my best to be proactive and anticipate what types of questions and what fears my investors have in these deals. And, the biggest thing that everyone's worried about is just collections. So, almost on a daily basis, I'm giving some collection updates, and then I'm trying to sprinkle in a couple other metrics. Like the other day, I did an analysis where our cash position is and our cash net of accounts payable, so people kind of see how well capitalized we are. Fortunate, the vast majority of the deals are pretty well capitalized. One or two might be a little tighter than we want them to be. So going through that on a regular basis. So I want to encourage you to be more proactive. You have your investors' money. You need to be communicative with them. You need to give them regular, doesn't necessarily have to be daily, but, probably through these times, a weekly basis. A lot of my time historically has been spent on buying or selling or refinancing deals. So now I have a lot more free time, seemingly, and nowhere to go, nothing to go see. So kind of gives me a little bit of a purpose to report the news every morning on what's going on our assets.
Yeah. Yeah. So what one question we got here was centered around make readies and just how will make ready cost and I guess the time spent on that sort of thing be affected by this health crisis right now. And then I'm sure your team has also probably given some thought to is there going to be a concern that the previous resident might have had COVID? I mean, what's the feeling around your management team right now with regard to that, and how are you all actually getting units made ready?
Yeah, so first, the turnover is much reduced relative to kind of this time normally. It's pretty busy time of the year as we kind of get into the leasing season and spring and early summer. So we're seeing less units turnover, one, just because everyone's hunkering down and staying in that place, where our renewal retention rates are through the roof. The ones that do come vacant are the ones that were vacant. Obviously we're coming in. The guys have the mask and protective material. So they go in, they'll disinfect the unit, they'll trash it out, get it made ready. We're just, like I said, we're doing normal turns. We're not bringing as many third-party vendors in, so you don't necessarily have as many guys. We're doing our best to try to save flooring and touch-up paint. Really trying to do our best to make a good product, but do it on within doubt, we're probably going to save the flooring versus replacing it this moment in time. Where if you were asking 90 days ago, we would have brought a third-party vendor in and probably turned that over, fully and upgraded these units. So I'm not as concerned about that. I'm more concerned about this service calls, maintenance requests on an occupied unit, and then sending, one of our maintenance techs into an occupied unit with 2 or 3 residents that haven't left for a month for the better part of it because they're stuck into their unit shelter in place. So those are a little bit more tricky. We're asking questions about, are you sick? Have you been sick? Used to be, did you travel out of the country? And that's kind of less of a question here recently, but making sure that the guys had gloves and N95 mask and do their best to take as many precautions. And, a lot of the stuff, if it's a simple maintenance thing, or even getting some of the maintenance guys to kind of FaceTime with the residents to see if we could give them the simple fix for them to do it themselves versus having our guys actually enter in the unit. So we're just doing our best to make sure we're just fulfilling any sort of critical maintenance issues, with the HVAC season upon us. As it's starting to get a little hotter in Texas, that's going to become more and more challenging as we get further into the summer, later spring and the summer, and the temperature rises. But we're just doing our best to minimize contact as much as possible.
Yeah. One last question, then I want to make sure we get to James so that we can talk through the debt side of things. But everybody has breathed a sigh of relief that, hey, April wasn't as bad as what we thought, and a lot of residents didn't take advantage of this like maybe some people thought they might. What do you see happening in May based on kind of how successful the April has been so far, and based on the fact that people will have the stimulus money, they'll have the enhanced unemployment, and they'll have potentially a tax refund, so they could actually have more cash in their pocket and get caught up, even some of the ones that didn't pay in April. So what is your feeling for May?
Yeah, I think wherever we finish for April in delinquency, I think those people, generally speaking, are going to not pay in May. So if I finish with, say, 4% in delinquency, I think we certainly the absolute ceiling would probably be 4%. in May, then I think honestly we probably deteriorate a little bit. So somewhere between 50 and 100% greater the delinquency. So I think if we finish a 4, I probably think 6 or 7 would probably be what I expect in May for delinquency.
Okay. So similar to April, but maybe slightly down.
Yeah, I think it probably 50
Revenue
rose
slightly
50%,
down.
50% more, than what we had in April, and that's a total wild guess. So I guess ask me in 30 days, and I'll tell you.
Yeah, that's right. Okay, great, Mike. Well, that's extremely helpful. Really, really appreciate your insights. James, why don't you give everyone an update on capital markets and where things stand today?
Sure. So yeah, Nick, if you can hear me, just pull up my slide real quick. Can you hear me okay?
Yep, gotcha.
Okay. All right. So I put this quote from Howard Marks, which is a famous investor. He really said, 2 keys during a crisis. Number 1, be insulated from forces that require selling. And number 2, be positioned to be a buyer. So that's how I broke up the slide. On the left-hand side, being insulated from forces that require you from selling is really number 1, impending loan maturities. So in the next, let's say 12 to 24 months, if you have a loan maturity, I would start the refinance process right now. I mean, we don't really know how it's going to be, and Fannie and Freddie are probably going to be your best options. It's going to be a little bit lower leverage, limited cash out. It might be even rate neutral, but just pushing out your maturity, probably 3 to 5 years, is probably a good idea. But then if you cannot make your debt payment due to a decline in collections, like Mike had, he's only 5% down, but if you're like 20, 30, 40% down, you really need to start reviewing your cash position and start thinking about forbearance. And Fannie and Freddie have sort of your set way. They essentially have a forbearance agreement. They're going to send it to you, and you're not really going to be able to negotiate it. And this is how it looks. Essentially 90 days, they're going to say, all right, you don't have to make your mortgage payment for 90 days. However, you're not going to be able to evict tenants while in forbearance. You're going to have to pay back principal and interest within 12 months. You're not going to get a new loan from Fannie or Freddie while you're in forbearance. And they're also, Fannie Mae is going to cash flow sweep all your excess cash during forbearance. And then you're going to have to work with any tenants who had COVID-19 or were affected by COVID-19 and not take any late charges. So there's not really that many positives of forbearance. Most of the people that I've been talking with, they're actually looking to probably do a capital call within either the general partnership or KP group or even one of your large LPs to really make it through, because you have to pay this back within 12 months. So you're going to have to make it up one way or another. And so if we go to the second point, which is, be positioned to be a buyer, a lot of people think this is pretty early in the process. It's only been 1 month into this. But in terms of Fannie and Freddie, the big thing that they've changed is really interest reserves. So Fannie Mae, people were asking about rates earlier. So Fannie Mae right now, spreads have calmed down. It's probably 3.5 to 375 on Fannie Mae right now on just the 10-year deal. But any loan over $6 million, they're making you put up 12 months P&I, 12 months taxes, 12 months insurance, 12 months of replacement reserve, and you have to hold that for a minimum of 12 months, and then you can release it after 2 consecutive quarters of 125. So on a $7 million deal here in DFW, is about $500,000 in escrows. So that's putting an extra 5% down on most deals. And then if it's below $6 million, you're having to do 18 months P&I. So that's probably close to 10% of your loan amount in escrows. What we're seeing also is supplemental loans, which is, in Fannie Mae, you're adding a supplemental loan. That's having the same reserve requirements, but assumptions are you can do a straight loan assumption without these interest reserves. And Fannie Mae is also taking away streamline rate lock. So before you could rate lock, 15, 20 days after a loan app, once you got the appraisal. Now you have to essentially wait till about one week before close, and then you can do it. Jumping over to the Freddie Mac, I'm going to focus a little bit more on Freddie Mac small balance this time, but essentially they make you put up a 12-month debt service reserve. They've also started pre-screening markets. So Fannie and Mae used to have pre-review, but Freddie Mac now has what they're calling pre-screen. Essentially for any market, Houston, New Orleans, Orlando, Nevada, Oklahoma, So really your oil markets, your energy markets, and then also your tourist dependent markets, they're having you pre-screen. They want higher debt service, lower LTV in those markets. And then also refinances, they're having to increase about 0.1 debt service coverage, and then also a 5% LTV reduction on Freddie Mac. And what we've also found out from Freddie Mac, there's essentially 12 Freddie Mac small balance lenders, and some of them, Freddie Mac basically went back to all those servicers and said, hey, within the next 18 months, if there's an issue with one of your loans, then you're going to have to buy it back from us. And what that has caused is a lot of Freddie Mac, probably about half of the Freddie Mac SBL lenders out there are putting on additional layers. And what that means is if Freddie Mac would have approved a deal at, let's say, 75%, they're going to 70% or 65%. Or Freddie Mac would have done a small or very small market, they're saying we're not doing any of those. And so depending on who your Freddie Mac SBL lender is, they're going to have different requirements. So watch out for that. And then I'm just going to end with this quote, investing is like a lot like soccer. You got to play both ways, and you have to know when to switch from offense to defense. And right now, I think the next 3 to 6 months is defense, right? So you're going to have to focus on collections, occupancy, avoid your forbearances, avoid foreclosures. But the next 12 to 24 months, the best investors are really going to switch over to offense and really start buying some distressed properties. But they're going to have to do it at lower leverage and potentially with larger reserves.
Mike, Becker, is there blood in the streets now, and are you buying stuff?
No one's selling anything, right? So I don't think so, right? I mean, all the debt's off except for the agency. So I think it's going to take several months of that. And really, I think my kind of crystal ball where I think there will be pain. I'm kind of on John Sebree's approach. I don't think it's going to get super bad, but where there will be pain, kind of the barbell analogy, Paul. I'm thinking the very top of the market. So it's like a brand new developer that's in lease up. As demand is shrunk, and they have a 300 unit apartment complex, 10% occupied, and it's going to take a long time to lease up. And or if you were maybe a little bit smaller, older, tougher workforce housing, have a high leverage bridge loan, maybe one of those vulture type lenders, debt funds from that were out of the market for the longest time and back in the market the last year or two. And you have a 85% bridge loan, and then your lender cuts off your capital that you planned on spending, and they just refuse to fund that. And then they lockbox it, sweep all your cash until you just sue them to go get their money out. Those people will probably have some pressure. But if you have an agency loan that was well underwritten and not a high crime area, that was a C or B class deal in a decent submarket, I think most of those guys should survive just fine.
James, how long do you think these new Fannie Mae requirements and Freddie Mac requirements are going to stay in place?
At least through the summer. Everyone, Freddie Mac, the way that they're releasing is basically they're saying, the federal sort of emergency declarations are shut off and everyone can go back to work. And then they want to see 3 months after that. So I'm guessing probably at least 6 months from now.
And then, Mike, what are some of the things that, you're a great communicator with all your limited partners and all your stakeholders, but let's focus on your biggest stakeholder, which is your lender. What are some of the things that you're keeping them up to date with so they know exactly where you stand?
Yeah, I think you share collection numbers because they're as curious as you are. Before this started in March, or before it really started getting into April collections, we shared a T12, a rent roll, and a balance sheet with all my lenders, so they understood kind of where I stood as we kind of went to the abyss. And we will now follow up with like a collection number on to all our lenders so they can understand what the scheduled rents were, what we actually collected, and what's delinquent. So they have a sense of kind of where we sit. And the forbearance discussions we have had, at least on the high level, have all been it's on a case by case as needed type basis. So if you can't show a hardship, it's not like everyone's going to get it type of thing. And each lender is going to be a little bit different as well. So if you go away from the agencies to a regional bank or debt fund, they're all going to treat you very, very differently.
And we're just finishing up on this conversation for everybody. But the biggest thing is in these transactions is equity put into these deals. We've kind of already talked about, where Fannie Mae and Freddie Mac are and where some of the banks are. But do we see the limited partners, the syndication, Do the people putting money back into these deals, do we see them coming back to the table? And that's a question for anybody to answer for me. I just want to get everybody's input of what they're seeing or what they're hearing or what their feeling is. Are we going to start to see these large syndications come back?
Yeah, Paul, I think it'll probably take a little while for that to get going. I don't know who's going to be the pioneer. Pioneers get arrows in the back, so I'm not quite sure who's going to be the first one to go try to discover price in the market. Maybe Nick. I don't know if you have a sense of that, but I think it's going to be, the analogy I used to use on 12 years ago, the bad old days. The last time I went through one of these was, the debt market's on and then turns off quickly. It's like a faucet; it'll immediately be turned off. It's kind of slow to be turned back on. It's probably the same with equity. I think it's going to be a drip instead of a full. Floodgates are going to immediately open. I think everyone's going to kind of dip their toe in until we get a little bit of positive reinforcement that the world's not going to end.
I totally agree with that, but I also think that today there's so much more capital on the sidelines than there was the last time around, and I think that if you take a step back and you look and say, well, what are their alternatives for investing right now? There's a lot of other segments of the economy that are not nearly as stable or as strong as multifamily. So I don't think it's going to be a flood of people coming back in, but I think that Paul, to answer your question, yeah, I mean, I would not be surprised if there are some people out there that are in a pretty good cash position and that are well leveraged, that were very smart with their acquisitions, that in the next 60 days, they're out there looking for that next deal. I think if Michael came across the deal and it looked like it was a pretty good deal and it had some cash flow in it, I would think Michael's picking up the phone and calling his investors and saying, "Hey, I think this is one we got to take a look at."
Yep.
Now, I've had a bunch of people that have asked me, how is underwriting going to change moving forward, and it's obviously, I mean, those are the kind of things that are going to determine whether deals start happening. Are we past the days of hard money? Is it just going to go back to where there's a bunch of contingencies? And a couple of comments that I've made and thought is, number one, there all the variables that we have in a normal deal: the debt, the equity. How do I underwrite the income? How do I underwrite the other income? How do I underwrite the insurance? How do I underwrite the real estate taxes? What about payroll? All of these things are very murky right now, and until they clear up, it's going to be very hard for underwriting, in general, not just for investors, but for lenders. How are we going to treat these months where we have no late fees and no app fees and limited turnover? I mean, I don't know. I don't know the answer to that, but I will say that as time goes by, I think these variables will become more clear. I have absolutely 100% agree with what Sebree just said, that everybody I'm talking to is pushed pause right now, but everybody is saying, hey, I've got money. I want to be investing. I want to buy another deal this year. I've heard that a lot. How long do you think we're going to be turned off for? I'm hoping to buy another deal this year. So I do think the appetite is there. I just think people are going to be hesitant and nervous to press forward until we can get a little bit of more answers. And I think those are going to start coming as early as next week. And again, we'll be trickling out in the coming weeks. And with that, I know, Paul, we've talked about this a little bit, but we're planning on doing this again 2 weeks from now. As again, this situation is ever changing. We would love to do another event here in a couple weeks, and with the idea of just keeping everybody up to date with the latest and greatest info in the market. So, there's a lot of questions. We're not going to have time to get to any more questions, I don't think, today. But I know I have nothing else to do. I'm sitting by my computer and by my phone all day, so I would love to answer questions for anybody offline. You can go to multifamilyadvisors.com, get my contact info there. Paul, tell everybody the best way for them to contact you.
Just go to oldcapitallending.com and track us down. But, I appreciate everybody coming on. Just like Nick said, we're going to try to do this in 2 weeks. We'll probably have a different panel. I know we're going to have a different panel, but we would hope that you could join us on that. I can't think of an initial better group of thought leaders than we've had today, starting with Nick Fluellen. Nick, one of the top producers, the Dallas-Fort Worth, Texas national market. He is just always a wealth of knowledge. So I always encourage you to contact Nick and the Marcus & Millichap. John Chang, unbelievable information. If you want to get on John's list, Nick and John will get you that information about looking at all the data that their group is able to produce. They are on the forefront of data. So get it in your hands. John Sebree, who's kind of the voice of wisdom, of kind of keeping us all calm over these traveling days of not really knowing what's going on out there. So John Sebree, we appreciate that. Michael Becker, always great to talk with you. What a great operator, great communicator. Your limited partners love you because you give them big bear hugs and you let them know everything's going to be all right by your continuous emails. And your lenders love you because they know exactly, are you a red, yellow, or green client of theirs? And hopefully that because you've kept on with a lot of money in your box to hold during this period of time, that they don't have to worry about a forbearance coming from you. And then James Eng, the professor, great insight. We do appreciate you spending some time with us and just kind of educating about what's going on. As Nick said, we'll give you a copy of all the slides that were in this presentation. We've also recorded it, so we're going to have that available for you in the next, say, 48 hours. Nick, anything more to add?
No, I just, again, wish everyone well. Stay safe, stay healthy, stay positive. We'll come through this, and there will be opportunities and deals, in the future. And in the meantime, if we can be a resource, we're here. So love to hear from all of you.
We appreciate it. Thanks to everybody for coming on. Stay safe, and as they say, peace out, and we'll see everybody later.